Hey, hi Deepak.
Hey Shekhar, what's up?
How are you doing?
It's been quite some ride, man. The last 1 year, it's
Yes.
been crazy. There's so many things that happened.
Yes.
I think our viewers would also want to know what really happened. So why don't we take a moment to give them few high-level
Yes.
overview on what really happened the last
Sure,
1 year?
definitely. In fact, we've been getting a lot of comments from our viewers asking what is happening at FactorLab. So we thought it would be a good recap at the year end to talk about all the changes that have happened at FactorLab. So the first question that I usually get is, are you guys doing this for the full time or are you guys doing it for the part time? So to be on record, Deepak quit his job at Amazon and has joined full time at FactorLab, and I also quit my job as a product manager at Jakarta and moved back to India, and we both started this full time. And secondly, the question that we usually get is what happened to Geeta. Geeta was, if you remember, was one of our partners initially, and now she has taken a personal break and has been working on her own project. So right now, Deepak and I are fully leading this. The other thing that many people ask is, what is your business model? Now, initially we started out doing with courses, and then we later moved to mutual fund distribution business. So let me give you a clear picture of what we are and what we envisage to be. So FactorLab is a full suite wealth management firm. That means we would want to guide our investors, our clients, and be part of their financial journey, investment journey, and ensure them that they reach their financial goals within their lifetime.
Yeah.
That is our major goal.
That's what I remember. Like in March, if you remember, right, we've sat through many nights
Yes.
to just set out our vision on what really we want to become.
Correct. Yes.
Right? And I remember the phrase, a full suite
Wealth management.
wealth management firm is what we want to become. And so far, you think we've done a decent job?
Yeah, absolutely. I think we liked the approach of taking a full suite wealth management firm because earlier we were too academic.
Yeah.
We were trying to be the wizards of how do you decode the markets, how do you back test it, how do you do better strategies.
Right.
But these are all numbers, and if these numbers which are on paper don't reflect truly into the bank statements of the clients, then what is the purpose of
Correct.
all this knowledge?
Correct.
So we want this knowledge to be actionable, and that's where we started
Absolutely.
our wealth management firm. The next question that I usually get is, we started our mutual fund distribution business,
Yeah.
and people ask, why did you start MFD?
Yeah.
Right, knowing well that MFD is these are regular funds, unlike the active funds. Regular funds obviously have a higher expense ratios. But when me and Deepak met a lot of clients, when I say clients, these were actually prospective clients, or you can think of, we did some kind of a pseudo research to meet different people, understand how they are building their portfolios, take a look at their portfolio statements or cash statements, and then come to see what are the common pitfalls that these investors are doing. I'll highlight a couple of common pitfalls that we noticed. One is that there is a very much recency bias that we observed in our investors or in our clients, that they pick a fund which is in vogue or in fashion, and if they see, let's say, the last 1 year or last 6 months returns are fantastic, then they just go and buy that mutual fund.
That's how people got into quant.
Quant mutual fund.
Yeah.
Not saying that it is a bad fund, but yeah, a lot of people have just kept on accumulating quant funds without knowing what they stand for, what they're doing it.
Right.
And this way they actually kept up accumulating a lot of funds.
Yes.
That is the second thing that we noticed. Each, on average, we at least notice between 15 to 35 mutual funds, not stocks, 15 to 35 mutual funds we have noticed in the portfolios of our investors.
Yeah.
The third mistake that we saw is they are being highly correlated, doing highly correlative investments.
Right.
Let's say they're over-indexing on one particular AMC, or they're over-indexing on only large cap funds, only small cap funds, or even though they're assuming that they're diversified by investing large cap, mid cap, small cap, when you actually do a correlation analysis, you see that none of these funds are actually uncorrelated. They're highly correlated. Now the problem of correlation, as everyone knows, it is that you get a very risky and highly volatile portfolios.
Yeah.
So it is essential that the portfolios need to be well balanced. So these are the three major challenges or common mistakes that we noticed, and we felt that after doing all this analysis, when we did the returns XIR of our portfolio or of our clients, and we compared it with Nifty 50, 95% of them could not beat the Nifty 50 after doing a lot of DIY investing.
Yeah.
So that's the peril of DIY investing. Most of them feel that they're doing something, but actually it ends up doing nothing.
How many clients do you think we've been?
Around 128.
128.
128 clients we have met before we actually jumped into this
Correct.
full time. So this was a great learning experience when we were doing. By the way, these all 128 were folks working in companies like Amazon.
Yeah. So some of these big tech companies.
Yes.
Yeah. They can actually code.
They are data scientists themselves, actually, some of them.
Yeah.
Nothing wrong in that, but what we're trying to say is that, while they are good at their jobs, they're good at what they do, we over time get into the habit of falling prey to certain psychological biases that we sometimes do not notice. Like I just mentioned, the recency bias, etc. And we once we fall into these biases, which are emotional in nature, not rational in nature, then we end up investing in subpar portfolios. And that is where we want to come into picture and help our investors make rational, scientific decisions. And with this, if we can provide alpha, after reducing the expense ratios also, if you're still able to produce alpha, that is a much better proposition for our investors, even if it being a regular funds.
Yeah.
So this is the exact pitch that we gave to all these 128 friends or clients of us, and we mentioned that we are investing in our regular funds. We'll be following an approach which is either fully passive, if they like, or it can be a combination of active and passive, if they're also okay with certain active composition, and we'll be able to do a greater justice of trying to beat the benchmarks post expenses. So that's been the pitch. And to give you a sense of the kind of business that we've built in the last 1 year, from let's say not even 1 year, from March 2025 till December 2025, right now we have around close to 300 clients across the country and across the world. In fact, we have clients from Dubai, from Singapore, from Australia, investing in our platform. And also within India, we have a lot of clients from, let's say, from Jalandhar, Jaipur to Coimbatore, Chennai, Bangalore, Hyderabad, Mumbai. So we have clients across. We've not met them in person, in fact.
Yeah.
Most of the clients, they know us by the YouTube videos that they've been watching, and they know us much better than any of others, and they reached out to us over Calendly links that we usually put out on our YouTube videos, and we had a long conversation over Zoom and Gmeet, and through that the onboarding is completely smooth. We have a completely automated, simple process, and they have onboarded on our platforms. With this 300 clients, we have now touching around 15 crores of AUM, and more importantly, the SIP book.
Yeah.
The monthly SIP book is close to 60 lakhs. That's a phenomenal number. That shows the kind of trust that they have with our process and the journey that they have been seeing so far. So that is about our mutual fund distribution. That is one key pillar in our wealth management full suite. The other things that we did in this year were we launched a backtesting tool, backtesting engine, which is free of cost.
Yeah.
And that backtesting engine got rave reviews, not only from the DIY investors, but also from the fund managers.
Yes.
In India and across the globe, we got a lot of fund managers in touch from Hong Kong, from Dubai, etc. Now, this gave us a lot of confidence that we can build solid infra on which we can bank upon to build our future strategies.
Yeah.
So taking a leap from that, we've built our own strategies, which Deepak will talk about it in detail. The other thing that I wanted to mention was, why did we choose MFD? While I mentioned that there are a lot of problems from the investor's point of view, but we also felt from the product point of view also, mutual fund is an excellent product. It is evergreen, whether you're investing 500 rupees or 5 crores. There is always a suitable and a right product available in mutual fund. You have very good diversification available in mutual funds, be it international, Indian equity, commodities, debt, corporate debt, so on and so forth. There are a lot of opportunities available in mutual fund. And secondly, you will get the best of fund managers at a very reasonable cost. That's the key advantages that we like about mutual fund as a product, and hence we feel this will be one of the central parts of our wealth management firm. Now, Deepak, I want to ask this question. While we were building on mutual fund distributorship, what do you think our USP is when we go and talk to our clients?
I think another nuance that I wanted to talk about is that most of our clients already have an existing portfolio,
correct,
right? And they have a good amount of money allocated to those portfolios, and they are still, working with us. And I think the key reason is that, the framework that we've built that identifies these inefficiencies in their portfolios, right? Earlier, you touched upon the correlation aspect of it, right? So many of them are just doubling down on large cap, mid cap, and small cap funds without really looking at whether they are highly correlated with each other or not, right? So they're just looking at last 1 year, 3 year, 5 year returns, and not probably looking at how they have performed over time, right? What has been the volatility, what has been the drawdowns, right? So I think the backtesting engine that you've just mentioned also really helped create these customized baskets for our investors, right? So I think we have investors ranging from returning NRIs to someone who is looking for retirement corpus, right? So we've been able to help them because for each risk and reward coordinates, we have a specific basket of funds that we have created, and essentially very well diversified. And we've also been able to rank each of these funds on multiple parameters. And this framework kind of helped us, recommend our investors that these are the funds that you can keep, these are the funds that you should exit from, so that your portfolio can generate that alpha over the benchmark, right? Otherwise, why not just invest in Nifty 50, right? So, and I think we've been able to also extend that same rigor, the data rigor, to the other products that we've been recommending to our customers, like SIF, PMS, AF, right? So for all of this, we've been able to get data, we've been able to do the same kind of rigor, and identifying those PMSs and AFs that are beating the benchmark consistently over time has been our USP as well, right? And recently, we've also done some videos around SIFs, right? It's going to be a very interesting product, something that we need to watch out for, given its limitations are different from what mutual fund limitations are, right? So you have that 25% cap on naked exposure, which is not available with a mutual fund, right? So it's going to be something that is going to be very different in terms of its positioning versus a mutual fund. And we'll continue to share more knowledge about how these SIFs are doing over time. And so far we've seen some bright spots with the SIF products that have been launched so far. And I think the most challenging journey has been procuring the research analyst corporate license. Right. I know we have the strategies ready, we have done all the backtesting, we have baked in all our personal experience into it, but we just cannot launch the strategy without that license. So it took us quite some time to actually get that license. So the minute we got that license, we've just gone ahead and launched 2 key strategies: adaptive asset allocation and dual momentum strategy. While we've been doing all of this, we've still kept our courses intact. But the change that we've made is we've made it a self-learning courses as opposed to doing a cohort-based learning. So I think those are some of the quick updates.
What do you think will be the focus for next year?
Yeah, I think our focus next year will be to continue talking to more such clients, more such investors, understand their stories. I think each one has a different story, different mindset. Every time I think I go with a plan in mind, the investor will come with their own story. So it's I would love to understand more of their stories and see how we can help. I mean, we've been building this institutional level knowledge, but sharing that with client is going to be key. So that is going to be one of the things that I would look forward to next year. And the second aspect is definitely double down on the research that we continue to do and incorporate that into our small case and also our mutual fund strategies. So these are the 2 aspects that I'm really looking forward to in the next year, and all the best for us.
Yes, absolutely. For the coming year, our focus is simple. We want to meet more people, and we believe that we are a quant with a heart, and we want to continue this journey going forward. Thanks a lot.
Thank you.